Welcome back to Golden Rule Radio this week. I got to take my mask off for you guys to hear me correctly.
We appreciate you wearing it all the time.
Yeah, we'd prefer you wore it more often.
Yeah, it's good to see you guys. Well, we're going to start this week's show and cover a lot of listener questions this week. So let's jump right in.
Yeah, let's do it. Not every week do we have the opportunity to jump into listener questions. This week you guys had some particularly good ones that draw attention, and we've got MKA Burley here. Yeah, so what if silver and platinum go to the moon? When that happens, so will a can of tuna fish, a hamburger at Carl's Jr., and a pair of socks. That is the point, Miles. I'm going to hand that to you.
If Carl's Jr. is still open.
Yeah, that whole listener question should just be the slogan for this podcast, in my opinion.
Asset purchasing power preservation.
Exactly.
Yeah, so what happens there, honestly, is instead of holding cash and those burgers and cans of tuna fish costing more dollars later, you're immune to that by holding physical precious metals that go up relative to the price of those other commodities or assets that you're buying. So there's your answer in short. Second question. One of you all mentioned last week that if you own 30 plus ounces of gold, you'd be in the top 1% when currencies reset. Do you really think that's the case? The top 10% for sure, but just curious.
Tori, I think you should answer your own question there because I think you're the one that was misheard.
Yeah, this is an important clarification, I think.
Yeah, no, it is. And I'm sorry to have misled you if we did. Here's the deal. If you own 30 ounces or more of gold, that puts you in the top 1% of gold owners in the world. So if there was a currency reset or a complete fiat currency collapse, and you were falling back onto gold as your remaining money, it would automatically end up putting you in the top 1% of wealth in the world, taking aside all other assets.
Sure, theoretical, hypothetical numbers.
But 30 plus ounces right now puts you in the 1% of all top gold owners in the world. Third question, if the price of gold goes substantially higher and people turn to silver, do you think platinum will also increase in price, or is its price based solely on industrial demand? Given its rarity and being less than half the price of gold, it does seem very attractive. Thanks from Australia. Underhand soft toss, Robert.
Yeah, I saw recently that the amount of platinum versus gold was compared this way. It was all the gold out there in the world that's ever been mined, ever known about, would fit into 2 Olympic-sized swimming pools, right? It would fill up 2 Olympic-sized swimming pools. And it was said that all the platinum out there that's ever been mined and known about would fill up 1 up to your ankles. The comparison there visually is pretty astounding. I've seen all kinds of different numbers of platinum being 5 times rarer than gold, all the way up to 100 or more times rarer. I think if you want to look at the details, I would refer you to the World Investment Platinum Council website. This group was started a few years ago, and they are trying to drive investment demand for platinum. So go poke around, do some of your own research on it. Keep in mind, they are trying to drive investment demand for platinum. So as you read some of the opinions there or the data, keep in mind they are trying to, I think, present somewhat of a bullish case. But given what's available in the platinum market right now, which is not much.
The rarity is showing.
It is showing the fact that you have a small amount of platinum.
I'm going to say one other thing before we transition to gold on that. Gold is going to act like the money metal first, just like what we're seeing, which is why the ratios are askew. Silver will follow as a partial money metal, but also industrial metal. Platinum, you are right, Neil, it is going to take industrial demand to probably really drive that. And when it moves, it will probably move more aggressively because of its rarity.
And that's kind of what we touched on last week with posing the question of what happens to these precious metals, the white metals, silver, platinum, maybe palladium as well. What happens when the world goes back to work and we get another opening of some of the industrial demand coming back into those metals? Do they turn bullish at that point? And so we're going to be watching that to see what happens with the prices there when the world gets back to work.
All right, chart guru, take us into gold this week, Miles.
Well, gold did do something it hasn't done in a while and actually put in its first lower high here about a week ago. So gold has been pretty much nothing but up, higher highs, higher lows since about March 19th after we hit the bottom basement and turned around, and has been putting in higher highs, higher lows since. So as we've pushed up to that 1550 to 1560 mark, we did attempt to push a little higher and failed. So we're kind of in between a short-term range here. Do we see another higher high, higher low, or could we possibly push below about 1675 and maybe have a little bit of a turn down? Now, as this has lagged out, I'd like to, looking at the charts here, take out that mid-March fall due to the national shutdown and the market collapse and everything. If you take that outlier out and you just look at a nice rising trend line that has been building since the beginning of 2020, I'm actually going to revise my downside target last week at 1585. I'm going to move that up to about 1620. And that's going to be my new short-term floor. Should we see this most recent lower high from end of April end up pushing gold down and us finally having a little bit of a correction back down. So in between those two prices, next week I think we'll know for sure if we're looking at a higher move or a lower move here in the next couple days. But yeah, I'd love to see gold come back down $100. We do have a fair bit of clients that are waiting to increase their current existing gold positions on some of those pullbacks. So those of you out there listening, keep an eye on the markets, get in touch with your ICA broker so we can start planning what the next couple weeks are going to look like.
Miles, I'm ready for that downturn. I hope you're right. Man, would it be great to have just one more opportunity here to add to ounces before that supposed climb. So it's going to shake out to be a pretty ugly Q2 and Q3, I think, and that's when really we're going to see more activity in the gold price.
Before we leave gold, just really quickly, we are heading into kind of the seasonal time where it is the time to buy going into your midsummer. It is almost summer, by the way. Going into May, June, those tend to be good months to be accumulating before you get into late summer, early fall and the Indian wedding season. So we'll talk more about that seasonal nature. The gold price did follow the seasonal nature for March being a down month. That's when we saw the pullback down to, 1450-ish. And so it has followed that, and now we're back up with a stronger month this month. And so going into some months where a good time to be accumulating ounces.
Moving over to silver. Silver has all but flatlined this past week. It has done, I think, no more than 10 or 15 cents a day, up or down any given day. When we get to the platinum chart here in a second, that'll kind of explain why I think what I'm about to say, but I do think we're going to see a jump up in silver over the next week, maybe as much as $1. Reason being, as we've been watching silver over the last couple weeks, we've been sort of hovering in between some more technical levels. We haven't really come into or come out of anything. I would think that we're going to see silver jump up maybe 1630 to 1650, and then we'll have to see where it goes from there. So silver, I've pulled my crystal ball out the last couple weeks here just for fun, so I'm doing it again. That's my bet.
I would agree with that. I mean, we had the downward move in silver, right, already, and so I think it's undervalued clearly, and it could move very quickly back up into the 17, 18 range.
If that happens, it sounds like you guys are corresponding that with a potential gold pullback. Regardless, probably look for a tightening in that ratio. We're at 111 to 1 today, a whole lot of ones, but that ratio has tightened down a couple of points in the last week.
Now, the reason I think silver is going to jump up is because of what the platinum chart's doing. So platinum, obviously, big drop in March. We had the same type of recovery, although a little bit higher than silver did. We've had a pullback back down since about the middle of April. Following on the heels of that drop, we've had 2 steps up, probably a third, which should bring us to around 870. That's the floor of the previous trading range back before the big drop. So that, to me, looks like a good resistance point for platinum that I see us stepping up towards over the next week. And with platinum coming up, I think that means other industrial metals are probably coming up some, and that's why I think silver is also going to move up and do something similar.
So talking about flatlining, Robert, why don't you go into the U.S. dollar this week a little bit and tell us what you see coming there?
Looking at it on a longer-term basis, it is forming a pennant consolidation formation. Which way it breaks out of there? What do we want to speculate on that?
Well, I think in the short term, I'll speculate a little bit. I wouldn't be surprised if it doesn't turn down a little bit. I think in the long term, if we go back to that 2009 when the dollar originally rallied and hit 100 on the dollar index back then, prior to QE2 and then QE3 rolling in, that's really when you saw the downturn, right? And we ended up coming down into the low 80s and even lower. That's, I think, going to happen again here, and that's when you're going to see that inflation is really getting legs, okay? And that's when also you're going to see the white metals get to running and gold even outpacing its current pace. Gold does much better in times of deflation, and deflation and inflation can take place at the same time. We talked about that in our staff meeting this week. ecospasm is the term that Don McIlvaney coined years ago.
Well, how many trillions of dollars, U.S. dollars, can you create before you force the dollar index down? What are we talking here? I mean, you'd create a few $1 trillion out of nowhere and the dollar index sits at 100.
Just planted there. It's incredible. I know. And here the Federal Reserve comes out today. We did get a little bit of a $10 pop in gold here today just because of the fact that the Federal Reserve came out. Jerome Powell said two things. One, they are not going to change the interest rates, which we didn't expect them to. Two, that they're going to increase their municipal bond buying program. So they're now saying they're going to buy $500 billion worth of muni bonds. They're already buying $41 billion a day in assets. $41 billion a day. So you're right, Robert. It's not just the federal government spending. It's the Federal Reserve balance sheet. So we're going to throw another chart up here for you here on the M2 money supply. Let this shock you. Let this tell you and affirm and reaffirm why you own gold for the long term. This isn't going to go anywhere, this money supply thing. They can say that it's offset by equities markets, value contractions, and deleveraging, and all those things. Man, this is ugly. The only reason that you're not feeling this on Main Street and not seeing it at the stores at this point is because look at this next chart. This next chart showing the velocity of money. And that velocity of money has just, it's gotten stuck in the mud, just much like you're seeing represented in the dollar index value.
Yeah, that's right. It's just stagnant. I kind of think about it as my bucket of dog water that I fill up with my dogs at home. When I dump it out, I refill it at the hose. I refill it really slowly so that the dog water that's hitting the bottom of the bucket doesn't splash up on me because it's kind of gross in the dog bowl. And so if you're filling up a bucket, right, you're creating this velocity of particles moving around. And you've got potential energy in a bucket that's sitting still. So if it's just sitting still, there's potential energy. And I fill it up very slowly so that it doesn't splash around, doesn't cause much action. But if I pick that bucket up and I start shaking it around, that's that kinetic energy. And that's the velocity of money. If I start shaking that bucket around, it starts splashing everywhere, all over the place. And that's not really what I want. But that's what we're about to have. We're filling up these buckets of money. And you start moving it around and that velocity picks up. And that's where the inflationary environment creates. I don't know when that happens, but that's the analogy that I think of, gross or not. That's it.
It's actually a good analogy, Robert, as funny as it is, because what you're describing is sort of a laser focus to where that money's going, right? They're trying not to stir up the dog bowl of water.
Keep it in a contained container, right?
Certain targets, the money's going to particular areas, trying to minimize the impact, but unfortunately, eventually it all gets out. There's just that much more wealth, that much more money in the game, and it might take a couple years. And just like it did, remember, gold and silver didn't hit an all-time high until 2011. The financial crisis onset was 2008. And then you had QE1, 2, 3, and TARP and all the other things that ended up driving those prices to all-time highs before they turned around. So don't expect something here this summer. It might take a year or two.
You know, if we put up these two charts, one being the money supply, which is an increasing line, it's going up, it's expanding, and then you've got the velocity of that increase in money. I mean, they must have bought some bigger containers because they're creating it. They're creating this potential energy, but they've not turned it into kinetic yet. So they've contained what they've created so far. But I mean, I guess the question I'm asking is when, and then what happens when you do start shaking that container around and the particles start moving around and going into places like the Carl's Jr. Burger and the different costs of things. That's what we're really talking about. It starts to affect you. The dog water starts to get on your hands, Miles, and that's
right.
Not where you want it.
That's not where you want the dog water, Robert. So, well, and we've been talking about this for weeks, right, guys? I mean, it's supply side inflation versus demand side deflation, and demand side is winning because we forget here in this country that while dollars are those magical things that we all don't have anymore, but they're in that plastic thing that we use at the grocery store, while those to us, that's what dollars are, to the rest of the world, the dollar is the safest investment available. So when there's a crisis, the rest of the world floods to dollars, and the Federal Reserve is happy to oblige when available.
Oh, that's exactly right.
And what happens 18 months from now when the rest of the world says, okay, we don't want these treasury bills anymore, we need to reinvest back into our own countries and diverge our investments into other countries who are stable again. And that's when the water gets on your hands.
Yeah.
That's when oil gets on your hands, too. I mean, if we lose that petrodollar effect and we don't have the world reserve currency, talk about compounding the issue, Right now, you've got exponential impact on that increased velocity of money and the increased dollars in the system because you don't have buyers. You no longer control the quote-unquote storage of that money because the petrodollar has been that for us for decades.
All right, so I know we got off on a tangent here, so we've got one more chart to look at, and that is the Palladium chart. Now, the reason I'm not just closing us out, and I do want to at least mention it, is because it ties into the other three metals that we talked about. I think gold's going down in the short term, or we're going to see a high here at some point and then a reversal back down. We talked about that already. I think palladium is doing the same. I think we are going to look at some lower pricing on palladium here over the next couple weeks. Now, the reason that matters and why I think it's worth throwing out before we shut down today is because of what we said about silver and platinum. I think silver and platinum are up. I think gold and palladium are down. We'll see if I'm right next week, but pay attention to your trading ratios. If you're looking at adding positions, adding ounces on something like silver at 110 to 1, and you think that ratio is going to get better, I wouldn't wait too much longer.
Yeah, I'll say too, automotive industry-wise, palladium's going to get a lot of downward pressure. We just got 4.8% reduction in the first quarter in our GDP. The GDP went down 4.8%. Folks, we haven't seen anything yet. Wait till you see Q2 numbers. Wait till you see some of the earnings coming out in May. This is going to get really ugly. And so economic contraction-wise, we are headed for a recession, at least, likely a depression, and that industrial metal will get pulled down just from that fact alone.
That does it for the Golden Rule Radio this week. We appreciate you listening. You can follow us on Twitter at ICA Gold. Like us on Facebook at McIlvaney Financial. Find us on our website, McIlvaney.com, or call us at 800-525-9556. Thanks for listening. Have a great week.